Hi, this is Morgan Smith, partner and advisor with WorthPoint, and I'm your host for this video here, which we're going to talk about the flexibility of cash balance plans. And I'm here with my special guest, Mr. Nate DeLong, certified pension consultant with Future Plan. Nate, how you doing?
I'm doing well, Morgan. Happy to be here.
Well, thanks for coming. Let's go ahead and dive into it here. And look at a lot of folks put plans together and they hit their headwinds, and next thing you know, you're getting blasted by everything that's coming at you. And I think a lot of folks may think, well, geez, if I get myself into something like a cash balance plan, it could be any other thing involved with their business. You know, one of the things they don't want to have to happen is that they get stuck there. They don't have any flexibility um, once they get in that situation. So we're going to talk today about some flexibilities that you have in cash balance plans, which I don't know who you've spoken with or if you know anything about cash balance plans at all. But oftentimes, some folks might think, okay, God, if I get in a cash balance plan, I'm going to be really um, restricted in what I can do. Now, I'll start off by saying, yes, there are limits within which you want to do, and we want to consult with you up front to ensure that you're a good candidate and make sure we look at all the benefits of it, but also the potential pitfalls, because it is a regulated oh industry, I guess you'd say. Cash balance plans are subject to the regulatory requirements and funding rules established by the Internal Revenue Service in the Employee Retirement Income Security Act, otherwise known as ERISA. And, basically these rules are in place to ensure financial stability and security of the plan for the participants. So all of these issues, you really got to make sure you uphold the regulatory requirements because they are for the benefit of you, really, the plan owner. But there are some flexibilities. There is some flexibility within the constructs of the cash balance plans. So let's talk a little bit about two concepts. Now, with a cash balance plan, every year you've got to fund it based on many factors: income, who's participating, age, and things like that. And there's essentially, at the end of the year, a firm like Future Plan, who Nate works for, will do all the testing on the plan based on the previous year's ending balance at the end of the year. And they'll say, okay, either the plan is underfunded or overfunded, or maybe you're perfectly funded, but I think that's not going to happen too much. You're generally going to be under or over a little. And, if you're underfunded a little, it's not too much of a big deal. If you're overfunded a little, not too much a big deal. But we kind of want to maybe expand on the scenarios where you're severely underfunded. Maybe uh, there's were some funding issues from a cash flow perspective of the business, or the performance of your investments didn't do well. Um, Equally is difficult to deal with, I guess, would be completely overfunded. Because if you're very much overfunded, you kind of lose that runway within which you'll be able to have those annual tax savings. And we can get more into that discussion on kind of the investment strategies. But I'll pause there. Why don't you, Nate, kind of dive into these two concepts and give us some thoughts that you might have as a certified financial pension consultant in constructing and your firm analyzing these on an annual basis.
Yeah, absolutely. I think when we're sitting down with a business owner and having that discussion about cash balance plans, I know a previous video that we did, your contribution is really based on your age and your income. And a lot of times we'll show a contribution amount. We always show the ceiling first. And sometimes the ceiling is a little bit too rich. So what I usually ask the business owner, the CPA, is find a contribution amount that you're comfortable making for the first 3 years. It doesn't necessarily have to be the maximum. Ideally, it's going to be more than what you would put into a 401k plan, but try to hone in on a number that you're comfortable making, a contribution amount you're comfortable making for the first 3 years. I would say if you're going to have a problem with funding, an overfunded plan is probably the better problem to have. And there's a lot of solutions. I know a lot of times these plans get cash balance plans are explained that they're very rigid, and it's really not the case. There are levers that we can pull, which is why it's important to work with a group of actuaries that has 30 plus years of experience working with cash balance plans. As you mentioned, they're always a little over, they're always a little bit under, and that's okay. When it's severely overfunded, there are some levers that we can pull. A group I'm working with right now is about $500,000 overfunded. And if they were to terminate today, there's a 50% excise tax on the overfunded amount. So, sometimes we might, for example, add a spouse to a plan, add another business partner to the plan, someone to help absorb that overfunded amount. Underfunding is a little bit more of a challenge. And if you're a little bit underfunded, easy to rectify. If you're underfunded by quite a bit, then a couple of the levers that we might pull, number one, we might freeze the plan. And that kind of stops all benefit accruals in their place. It gives the business owner time to catch up on the funding. And that might be 1 year, it might be 5 years to get caught up on the underfunded amount. And once they're caught up, if they want to unfreeze, kind of so to speak, and start funding again, we can just pick up from that day moving forward. Another solution to an underfunded plan might be to amend the plan and reduce the owner's contribution amounts. Generally, if there's employees and we have defined their benefit, we cannot claw back that benefit. So those contributions would remain static, but those are usually small contributions in the low 5 figures. It's usually the business owner's contribution that's up there in that 6-figure kind of area. So having an underfunded plan, we can freeze, we can amend, and we can also terminate. So if you have a business reason, we can terminate the plan, and all contributions would cease. But these are topics that annually we're going to have with our business owner clients. Based on their funding status, we're always going to provide them with 3 sets of numbers at the end of the year. We're going to give them the contribution amount, so the plan is fully funded at the end of the year. We're going to provide them the minimum amount, realizing business fluctuates. The contribution to the cash balance plan can also fluctuate. So we'll provide them the minimum contribution amount they need to make to the plan. So, it's properly funded or funded to, 80%, for example. We're also going to provide them a maximum number. So if last year they had a better year than they anticipated, they can put away a little bit more than they normally do and enjoy a larger tax deduction for that business year. But it's important to work with a group of actuaries that understand these dynamics, and they're able to take time to consult with a business owner and their CPA and their financial advisor on what the funding's going to look like. And if we do see more headwinds coming, global pandemic, for example, there are some levers that we can pull to help freeze the plan, maybe mitigate the risk, let the headwinds pass, and then resume funding.
Interesting. I like that rule of thumb. I mean, that is a great rule of thumb. Let's kind of plan on what you feel comfortable for the first 3 years. So in summary, big picture, a cash balance plan, you are planning towards, it's different from a 401k where you're planning just the contributions. You kind of look at what the benefit amount is and you plan backwards. And every year you've got these funding amounts that you need to basically adhere to. And so as you go through the years on an annual basis, we're going to look at the funding, and we'll say whether or not you're underfunded or overfunded. And we're just about to look at kind of some variables there. So that's generally how this works. And I think one thing to note from an investment standpoint, the more variability you have in your investment performance, the potential more problems you'll have. And that's why the investment strategies, where is really my focus for cash balance plans, are so important, because what you want to do is you really kind of want to reduce that variability around the credit rating, and that's another topic we'll talk about. Let's just say we want to and reduce the amount of ups and downs you have on an annual basis for the cash balance plan. So hopefully that'll give you, the listener, some insight into um, cash balance plans and the annual testing that goes on, and this idea of underfunding versus overfunding. So continuing on with this conversation of plan flexibility, this is just a hypothetical example of an annual funding report. Just a piece taking out of an actual report that is going to be several pages long and really explain a lot of different metrics of the plan and the options. But what I like is just saying, hey, look, here's the current year's funding requirement for 2020 to for January for 2020, essentially. So this business owner's got this report at the beginning of the year sometime, and they say, okay, here's what you can fund at. Here's your minimum required contribution, and here's your recommended contribution. So just in the normal scheme of things, they've already got a flexibility of amounts that they can put in above and beyond what you're talking about with things like amendments and things like that. Can you talk a little bit about just kind of the normal flexibility on an ongoing basis?
Yeah, it's year one, we always know what the contribution amount is going to be because it's all designed, it's put into an illustration, and sometimes we get to version 3, version 4 of the illustration as we're tweaking the numbers to the business owner and kind of CPA's liking. So we always know year one what the contribution is going to be. Year two, you'll receive a report that looks like this based on investment performance and a few other factors, income, profitability, for example. We're going to provide this range. And what you kind of take away from this range, it's a pretty wide range. 118,000 or so is what it's going to take in required contributions so that the assets in the plan meet the liabilities. They meet the defined benefit. However, if there were headwinds in that particular year, or maybe it was a bit of an off year, the minimum required contribution is about $100,000 less. So I think very palatable still to make that contribution and have the plan funded for that year. The plan would be underfunded at the end of the year because we didn't put in the recommended. And in a future year, we may have to make up a portion of that contribution. But, the variance here is pretty wide on what's suggested contribution so asset meet the liabilities, and then what the minimum required contribution would be so we can fund the plan and not have a funding deficiency.
Good. So I think the big takeaway here, just in the normal kind of plan testing, you've got a wide range, in my opinion, a surprisingly wide range of options as far as how much cash you need to put in. And if you're having kind of some cash flow issues on that year, you've got some flexibility there. I think the thing to remember is that you're going to have to address that in future years. But again, this type of flexibility can help you out, and you're not just completely constrained and necessarily, as we would say, put in a hurt locker just right off the bat and with no options. So I think this is a point that you brought up, Nate, and I really like this idea of a budgeting risk analysis. And as a financial advisor working with individual clients, I do the same thing up front. It's just like, okay, let's kind of do some budgeting and see what you can afford rather than just putting in a plan and hoping to be able to maximize this. Can you talk to us about the budgeting risk analysis and that process, and why you think it's important for business owners to do this up front?
Yeah, I think most business owners that I meet with and most CPAs, when we put these plans in place, they like to be able to budget for those future required contributions. So once we kind of settle on a contribution amount that the business owner and CPA and advisor are all comfortable with, that's going to be the goal moving forward. So it's important to find that number that you're comfortable contributing. It's not always the maximum. Sometimes it's a little bit less, and that's okay. But having that amount in your mind, and being able to budget for that, and then definitely, working with someone like yourself, Morgan, that understands that the contributions in the cash balance plan need to be managed a little bit differently than maybe some of your other investment portfolios. This is really your safe money. So we're targeting around a 4 to 5% rate of return with as little volatility as possible. And if there's little volatility in the portfolio, and we're at the end of the year getting a 4, 5, 6% rate of return, maybe a little bit more, a little bit less, that's quite all right. Because when we come back to the business owner the following year and we run our calculations and we show them the contribution requirements and the minimums and the maximums, they're within a range that those individuals have already budgeted for. And it's not outside of that range. They're not down 20% in the portfolio and now have to make up for that loss in investment principal. So it's important to budget for that. Again, we like to use about a 3-year window. If there are, dynamics, headwinds, etc., we can amend the plan if there's a business purpose. But it's important to go into it clearly, that you understand how much you're going to commit for those first 3 years, and that we're targeting a specific rate of return to keep a lot of the volatility kind of out of the plan.
Well, I think you bring up a lot of good points, and I think one thing to look at. Let's say you've got, I think the middle points there: early years, lower balances, you've got a lower funding risk. Later years, higher balances, a higher funding risk. I think this is a topic worth exploring, taking a moment on just to talk about. Because, for example, you could have a cash balance plan right now that's got a high balance, and you may not know it. You might have a higher funding risk. And, if you're not talking about it, this may be an opportunity to talk to us about it and say, what are your options? I mean, potentially you could terminate the plan and start another one down the road, just to lower your funding risk. Can you talk about the funding risks and what are options if you think your funding risk is too high and you've got too much money in there and you'd like to reduce that?
Yeah, I think you're very correct there. That early on in the first couple of years of the plan, I think the funding risk is a little bit less. If you're putting, for example, $200,000 a year into the pension plan, and at the end of the second year you're down 10%. Okay, instead of having 400,000 in the plan, you've got 360. So you're not quite fully funded, but you're not too far behind either. It's when you're out in those later years, year 10, at 200,000 a year, and you should have close to 2 million in the plan. And maybe you've assumed a little bit too much risk in the portfolio, and you're down 20%. So instead of 2 million in the plan, you've only got 1.6 million. So the assets in the plan do not meet the defined benefit. They don't meet the liabilities. So as you get out into those later years, it's more important in those later years to strip out as much of the volatility in the portfolio as you can, especially when you get closer to termination. I always say, the two most important aspects of the retirement plan, I think number 2 is the establishment. I think the number 1 is the termination. So when we go to terminate the plan, do the assets in the plan meet the defined benefit and meet the liability? And they never do. You're always a little bit up, you're always a little bit down. So at that point, maybe a plan amendment would help fix the overfunded or underfunded amount. So there's things that we can do there. But you're right, as you get into those later years, there's a little more risk in the portfolio volatility.
So I will say, let's say you're a cash balance plan owner right now, and you've had it for some years and you got a high balance in there. You've got a higher funding risk, and it becomes more critical how you invest those investments. So if you look at that plan and you've got a pretty significant exposure to stocks in that plan, that may not be the right thing for you. And I would say, as a general rule, if you've got some significant assets in your plan, you no question, you've got a higher funding risk. and you're trying to do it yourself, or you don't think you have good advice on the investment side, that'd be a conversation to have with me, because there's some very just interesting things that you can do to reduce that volatility and reduce that funding risk. And that's where we come to that second last point: professional investment management. And this last point here, cap funding. Well, what's that?
Plan document, cap funding. So the document's going to dictate the funding amount each year, and written into the plan document is the actuarial formula, and it takes different things into consideration, right? We stated the rate of return in the document, 4 or 5, maybe 6%. There's also some interest rate assumptions, and those change every year as the IRS introduces its tables from year to year. We don't know what they're going to be. So there's a little bit of risk involved there. But the plan document's going to dictate the benefit formula, the interest crediting rate. And so if we do need to make any changes to the funding, to cap the funding, for example, so no more than 100% of W-2. And I'll give you an example. I wrote a plan just like this a few weeks ago for a business owner that wanted to strip out some of that volatility. So we have options where we can pick a fixed amount. So we're going to strip out that rate of return, and we're just going to target $100,000 every year or $200,000 every year. We're just going to fix it. One other things that we can do is we can tie it to a percentage of your W-2. If you're an S Corp or a C Corp or professional service corp, for example, 100% of your W-2 each year. There's a few other things to consider when we structure it like that. But in working with your CPA at the end of the year, if you want to do a $200,000 pension contribution, make your W-2 $200,000. If you had some headwinds and you need to drop your W-2 to $125,000, your pension contribution is $125,000. So we can tie the contribution amount to your W-2. Sometimes we'll do 125% of W-2 or 80% of W-2. So that gives you flexibility to move your W-2 around and also to massage the required contribution amounts each year. Some just want a fixed amount. We don't want the range. We want $180,000 a year fixed, and that's where we're going to peg it. And remember, we can peg it there, and we can amend it later if you have a business reason. So there is some flexibility. These plans aren't as rigid as they're often portrayed. It's working with the right group of actuaries that understand what are the options, what can be done, and there are deadlines on how to fix these plans. So if we need to fix them mid-year or we see headwinds early, let your actuary know that we may need to do some redesigns or amendments. The sooner we know, the sooner we can correct the issue before it becomes, perhaps a bigger problem.
Great. Well, capping that funding is just another lever that we can use for flexibility. I think for unforeseen business cash flow constraints, I think we've basically covered a plan amendment, terminating the plan, freezing the plan. Can you just, I think a lot of people get confused between the difference of freezing a plan and terminating a plan. Can you clarify the differences between those two options?
Yeah, termination is shutting everything down, stopping the plan in its tracks, and usually rolling all the assets over to an IRA, doing a final calculation, sending stuff to the IRS, maybe getting a favorable determination letter at plan termination to kind of hold on to that, hey, we properly terminated it, and maybe got the blessing that it was properly funded at termination. Freezing the plan happens pretty frequently, actually. A few examples I've had with groups, especially during COVID.
Yep.
We sent out a letter to all of our cash balance clients in March of 2020 that if you think this COVID thing is going to negatively impact your business and may create some funding issues down the road, give us a call immediately and instruct us to freeze the plan. And a lot of business owners did, and we froze their plan kind of right in its tracks. So before anybody works 1,000 hours, which is right around May or June, if you're working full time, we can freeze the plan and no benefits accrue for that year. So, if you've got a 6-figure required contribution each year and we freeze the plan early in the year, there's a real good chance you're not going to have to make a funding contribution for that year. And fast forward to 21, maybe 2022, it's still frozen. You still haven't accrued a benefit. There's still very little required, if any, funding requirement for those years. Obviously, you don't get the tax deduction. You're not making contributions, but you've taken that risk out of your business, that I don't have to dedicate these dollars to funding a pension plan. If there's headwinds, they can be allocated other places. A group I was working with in 2020 that was in the t-shirt business, they called us and they froze their plan. About 3 months later, they called and said we had converted our t-shirt factory to a mask factory. And they went from, they more than 10 times, right? It was a great business decision on their part, but they said, not only do we want to turn the plan back on, but we want to increase the funding significantly because our profits are now through the roof and we're looking at a very large tax bill. So we unfroze the plan. We amended the plan to increase the benefit formula for the business owners, and they all quadrupled their pension contribution for the next couple of years. So freezing it is one solution if there are headwinds. Amending it and maybe reducing the contribution is another. Sometimes we amend it and we increase the contribution because business is taken off faster than we anticipated. But those are levers that we can pull, and having an actuary that can have those conversations with the business owner and the CPA to understand how the dynamics of the business are changing, and do we need to freeze, or can we amend? Should we amend? Those are all conversations that we have very frequently with our business owner clients.
Well, I think these types of options and information is really, really informative and beneficial for business owners who maybe have cash balance plans now and they just haven't been educated on it or are contemplating it. It's amazing when you start digging into things, how many different things you can think about. And again, it just kind of makes people realize that like these things are complex. You need a higher level of expertise, and what a benefit that folks like Nate DeLong at Future Plan can help as far as planning and giving options. And look at the cash balance plans themselves, kind of regulate a lot of that. So I'm going to sign off here. I hope you found this informative. Again, I'm Morgan Smith. I'm a partner advisor with WorthPoint, and I'm a financial advisor. I typically work with families. A lot of times I work with business owners and help them implement their cash balance plans. And my area of expertise and focus is on the kind of unique investment strategies that I feel are required for cash balance plans. You can see my point of contact information down there. Feel free to reach out to me at any time. And of course, Nate DeLong, certified pension consultant and vice president with Future Plan. You can see his email down there. Nate, I just want to thank you for joining me. I thought this was a very informative. Thanks for your insights, and we will see you on our next video series.
Thank you.
Take care, Nate.